Or let's get some insights on the news that's shaping markets. For that, I want to welcome in Sam Stovall, Chief Investment Strategist, CFRA. Sam, I'm glad you could be with us this Friday. It's always good to hear from you. All right, let's start with what happened. It started shaking up markets overnight. You still have equity under some pressure, crude oil rising following Israel's airstrike on Iran and its nuclear program facilities. Right before that, you had the S&P 500 starting to continue to creep higher, and we were within spitting distance of those all-time highs that we'd established earlier this year. What's your reaction to what we're seeing today?
Well, Diane, my reaction was initially that the futures were not down as much as I had anticipated after such a surprise attack, possibly because investors realize that usually military surprises end up being swift and shallow, but we'll see whether that happens this time around. Also, I think investors believe that while Iran could possibly end up with conventional strikes in response, they probably won't end up shooting themselves in the foot by trying to close the Straits of Hormuz. That would send oil prices up to about $100 a barrel or higher, and also cut off their ability to export to China. So the feeling is that we're probably not likely to see a big escalation in military tensions over there, but we still have to take a wait and see attitude.
Okay, so given that what you said about the potential for oil prices to move over $100 a barrel, I mean, do you think that's a real risk here? Because I know previously your base case has been $65 barrel oil this year. Does that remain your base case, or is this kind of a wait and see what occurs here?
Well, it does remain our base case, and we do think there could be some slight upward pressure as we move into 2026. I think you cannot ignore the tail risk of there being a shutdown of the Straits of Hormuz, which would put prices up to about $100 per barrel, but that's not our most likely case at this point. Our belief is that this is another in a series of Middle East tensions. This was something that, in a sense, was building. We got a sense of it because of the removal of U.S. diplomatic people from Iraq ahead of time, et cetera. So it's something that some people were anticipating to possibly occur in the near future. So really, the question is also about Iran's oil, 1.5 million barrels per day, but then non-OPEC could possibly make that up with almost 1.3 million barrels of spare capacity.
Okay, I'm curious to know your thoughts on volatility. I mean, the VIX is just above 19. Volatility is higher today, but not as much as you may expect in a situation like that. How do you read through that?
Again, I think it implies that while we probably could see a digestion of the recent gains, because we think a lot of the stocks are overbought at this point, it does not derail the bull market. And we are likely to see the correction be totally reversed sometime soon. So reminding investors that the market has tended to advance an average of about 10% after getting back to break even from declines of 10 to 20% over a 4-month period. I think Wall Street believes that that is still on track.
Okay, so Wall Street believes that's still on track, and you think that's why we're not seeing as much of a risk-off tone in terms of equity price action today?
I think it's primarily in response to expected reactions from Iran, and that we're not going to be seeing an escalation from here. I think that's what's driving the market to not be pushing the prices down dramatically more than we are now. But that could obviously change. So I would tend to say, the more logical case is near-term weakness because of this situation, digesting some recent gains. Intermediate, longer term, the market heads higher, but there's always that risk that things could get worse.
Okay, there's always that risk that things could get worse. Sam, since we have you, I want to ask you really quickly your views on the Mag 7 now, they had started to regain some ground. Obviously, today you're going to see more pressure within that sector. What's your view on the Mag 7 as it relates to positioning through the balance of this year?
Well, we still have an overweight recommendation on communication services and technology. These were two of the three worst performing sectors during the near 19% decline from February into April. And we typically find that those groups that were beaten up the most tend to bounce back the greatest. Those two would be among those that we still favor and think that history would imply that they could have further upside potential. Also, when you look to earnings growth expectations for 2025 and 2026, technology is expected to post among the strongest earnings growth, 18% for 2026 versus 13 for the overall market, and also tech holding up quite well in 2025 at 16% versus the market's sub 7%.
Okay, and Sam, market is going to be looking ahead to next week from the Fed, hearing from the Fed. Consensus expectation is that we're not going to get a move on rates in terms of a cut there. The consensus is that we're going to just see a holding pattern here. But what tone are you expecting from the Fed Chair, Fed Chair Jerome Powell? Are you expecting more dovish, more hawkish, or just something more neutral?
Well, the Fed is going to remind us that they are data dependent, and that right now the data continues to imply that there's no need to be cutting interest rates this month. We still have in our forecast that they will cut by 25 basis points in September. And the June FOMC will be accompanied by the SEP, Summary of Economic Projections. We don't see a big change from the March numbers, but I think a lot of that SEP and dot plots, et cetera, will give us some guidance as to what the Fed is thinking. And based on the most recent readings for CPI, PPI, and PCE, the inflation measures, all three showing downward moves over the last several months, that would be encouraging as well, that possibly the Fed will cut rates in September.
Yeah, it's always helpful to get the dot plot. Sam, thank you so much. It's always great to get your perspective. That's Sam Stovall, Chief Investment Strategist, CFRA. Sam, have a great weekend.